In this video, we're going to discuss late-stage base failures and why it's best for traders and investors to act cautiously, if not flat out stay away from bases that form late in a stock's advance. Historically, breakouts from first and second stage bases have a high success rate. However, by the time a stock is building its third and fourth stage bases, it's become pretty obvious to the crowd, who unfortunately tends to be wrong most of the time. According to Bill's book, How to Make Money in Stocks, fourth stage bases fail as much as 80% of the time. So that being said, let's go ahead and take a look at a few examples. And I'd point out that the next few charts we'll be looking at are weekly charts, which are the easiest way to count a stock's base stages. The first example we're going to take a look at is Amazon's weekly chart going back to its IPO in 1997. Here we see its first stage base. We've got an IPO U-turn that attempts to break out without consolidating first, so not surprisingly, it never makes its way out of there. And here we've got our consolidation that we didn't have before we attempted to break out through highs, which actually goes on for enough time to become a new base. But regardless, this entire structure is a stage one base breakout, which, as we discussed, has a high probability of working. So stage two, we've got a cup and handle that forms here and a breakout that ultimately comes back in and takes, it looks like a second and even a third time before it actually breaks out and goes on to consolidate a third time and form its third stage base here, which is a flat base. And we can see the constructive action here. The stock drifts nice and tight, volume falls to below average, and then massive volume comes in and pushes this for a big breakout out of a third stage base, which is becoming late. And this is where I look at it this way. Third stage, I'm very cautious. So this base here is extremely constructive. Had it become wide and loose and there were flaws I could find with it, I would be more cautious. But the way that it acted on light volume and then exploded again on extremely heavy volume, that's telling me that this one should be good to go. Nevertheless, we've always got sell stops in mind to protect ourselves, when this is going on. So coming out of this third stage base, you can see we consolidate a fourth time. Now on this base, we start to get much more whippy and volatile, wide and loose in our action relative to the action back historically just a few months prior, weeks and months prior. We've got a big sell-off here, and we continue to whip around wildly until these few weeks in here we tighten up considerably and attempt to break out of a fourth stage base, which is a clear late stage consolidation, and as we discussed, will fail 80% of the time. So at this point, once again, we've got massive volume that pushes this stock out to new highs after tightening up for a few weeks. So again, there's nothing wrong with taking this trade as long as you're aware that we now have a late stage base. It's whippy, wide and loose, has a very high potential of failure. However, this was a huge leader and it was able to push on once more. So as we form our fourth consolidation or fourth stage base here, notice how we start to become much more whippy, wide and loose than we were during the base building process previously. We tighten up a little bit, but ultimately roll over on heavy volume and sell off almost to its 40-week line or its 200-day moving average on a daily chart. And the pattern remains pretty volatile. However, you can see this week starts to tighten up like it did here for a week or two. And then we've got another 2-3 tight weeks on top of that, not to mention we've got 3 weeks tight and massive volume pushing this for its fourth stage breakout, which, as we discussed, is going to be highly failure prone. But when you've got a big leader like Amazon with the giant earnings and sponsorship, there's nothing wrong with giving this a shot as long as you've got your sell stops in place and are clear with the risk you're dealing with here. In this particular case, it didn't make a difference. Amazon explodes out of its fourth stage consolidation. It goes almost vertical. We'll point out its widest weekly spread of the entire move. We're also going to take a look at this on a daily chart when we get into discussing climax tops. And this is also why I said earlier that climax tops and late stage base failures will tend to go hand in hand. You'll notice after this climax move, we've got the wide, loose, volatile action again. It carves out a very deep base again, which ultimately attempts to break out but fails, rolls over, and starts breaking its major moving averages. Its 50 or 50-day moving average, which is its 10-week line, starts with a little support at its 40-week line, which doesn't last long, and you can see we eventually roll over and break down from there. And so by the time Amazon starts working on its fifth consolidation, or what would be a fifth stage base, the one thing I would point out here before the breakout relative to here and even here where it starts to tighten up is the fact that we do start to get a little bit of tight action, which is constructive after the wide, loose, volatile action. Same thing here. It gets extremely volatile again. However, we get three relatively tight range weeks compared to everything else, not to mention 3 weeks tight, which is an indication that a stock is under accumulation, and then the big volume pushes it out here. Now Amazon goes on to form its fifth consolidation, or what would be a fifth stage base, and we can see here it never really tightens up before it attempts to break out, and it immediately fails and continues to break down through its 10-week and 40-week moving averages. We've got what they call the death cross here, where we've got our 50-day moving average or 10-week line crossing below the 40-week moving average or 200-day moving average on a daily chart. The next stock we're looking at is GSX Tech EDU, an education stock which IPO'd back in June of 2019. You see again here, we run up straight up off the bottom, attempt to break out without any consolidation, so it's not surprising that the stock comes right back in. We attempt to break out again, which fails. Not only shakes out below its IPO high here, which was the pivot on the way out, but it also gives a good shakeout and retest of its 10-week line, which is the equivalent of its 50-day moving average. Notice as the stock starts to clearly tighten up here and respect its 10-week moving average, volume tapers off, which is a very constructive sign. Again, volume explodes, the stock breaks out and goes on a massive move from $18 well through 40, more than doubles in a very short period of time. And not surprisingly, we get a very sharp pullback. And looking at this action in here, this is already giving you a clue as to the nature of this stock. After it breaks out, it whips around wildly until it tries to consolidate again and explodes. So this wild, whippy nature is not surprising. This winds up counting as a flat base. It's over 7 weeks here, clearly. However, it has that double bottom-esque look to it. We've got a clear undercut and shakeout below this prior low and this prior low for whatever it's worth. That's a good thing. However, that does not make a difference to the double bottom-esque look of the base. If this were a proper double bottom, you could buy through the middle of the W, so to speak, which happens to, it looks like it may actually work here if you wanted to cheat your way in early, and then eventually we get a breakout through highs, again on massive volume. The stock goes on an almost vertical run, and we'll point out here at its very top, we pull back to about mid-range, which is a tough call. It's well off its lows, but certainly not ideal. And we'll point out that this is the widest weekly spread of the entire run, which is a clue that we may have a climax top in effect here. And we're going to discuss that in just a little bit, and when we have a chance to bring up daily charts next to these as well. The next chart we're going to take a look at is Qualcomm's weekly chart, going back to the late 90s again. Our stage 1 base starts right here. We've got a classic cup and handle base formation. Qualcomm breaks out and goes on a massive move on extremely heavy volume before it consolidates a second time. Right here, consolidation 2. So Qualcomm breaks out of its second consolidation here. It's not a proper base, however, it would be an add-on point after it shakes out and successfully retests its 10-week line or 50-day moving average on its daily chart. It continues to move higher into a third consolidation, which ultimately, again, retests its 50-day moving average along the way before it breaks out again. These are both add points along the way. And so one last shakeout below its 10-week moving average, or 50-day, as it were, on its daily chart. We tighten up again here, 3 weeks tight, and Qualcomm breaks out for a final time and goes on an almost vertical move from its 50s to almost $200, which is a massive move higher. So even though we don't have full proper bases built here, the point is Qualcomm is very obvious to the crowd at this point. If you missed it here, you had more or less a lockout rally as it tripled. I'd point out that Qualcomm is clearly not a classic situation or a classic example, as you never really get any proper bases that form along here. But I would say this, after the massive run out of its first stage breakout, even if you were to count this as, let's say, one big ascending base, all as one structure, and you've got this breakout, you've got this consolidation here, consolidation 5, again, not really a base, a bull flag of sorts, and breakout. But I think at this point, it's very clear that this is a stock that's getting late in its move. We started back here in the end of 98, beginning of 99, by breaking out at around $8 and running up to 200 just a year later, which is an incredible move. So by the time we're breaking out of this consolidation or formation, I don't think it's lost on anyone that this stock is later stage, and caution should be taken as it's coming up and out of here. And again, you'll see we've got pointed out this is the widest weekly spread of its entire run, which is often an indication that climax top is in the works. The last stock we're going to take a look at is Charles Schwab on its weekly chart, again from back in 98 and 99. Charles Schwab breaks out of its first stage base right here, which is a cup and handle, which forms after a failed breakout attempt from a flat base back here. In any event, this time we get the breakout. Even though it retests, it sticks the second time. And while we're talking about that, I think it's worth pointing out that this is where patience is required. When Bill did the study and came up with the max sell stop rule of 7 to 8%, it's not just because that's about as much as you want to lose, because having to make back more than that becomes exponentially more difficult. The real reason is that when you're buying a stock that meets all of the CAN-SLIM characteristics, that's breaking out of an early stage base on big volume, 70 or 80% of the time, that breakout should never fall 7 or 8% from its pivot point. So that is the real reason for that max sell stop. So when you've got a stock breaking out of a third stage base, while yes, we'll still employ a 7 to 8% max sell stop, that's where you want to be cautious and start to tighten it up anyway, because that is, again, why we're going through later stage bases. Once you're up at third and fourth stage, the stock is obvious, not to mention those sell stops become less useful once your odds of success go down at that point, up at that stage 3 or stage 4 base. So I just wanted to throw that in there. Let's get back to the example here. So Schwab ultimately breaks out of a stage 1 cup and handle. It rallies almost 50% or so before we consolidate again. We don't get a proper base formation here. However, it does consolidate constructively and give us an opportunity to add to the stock, and it's still plenty early enough from this breakout to add stock in here. Again, similar to our last example, we don't get another proper base, but we do get a bit of a flag formation of sorts. It's a bit wide and loose, but eventually after getting support above its 10-week line, Schwab tightens up again and goes on a final run here. Again, you'll notice that while we don't have our widest weekly move here, it's worth noticing that you've got an almost vertical move in just 2 weeks after it had already moved 200%. So when you've got this sort of move on top of all, a 200% move already, that's worth noticing, especially when we fail and close on lows on the biggest volume we've seen in quite some time. So as you see here, we go on to consolidate a fourth time or build a fourth base potentially, which ultimately fails and breaks down through its major moving averages.